You get your like random bros who are like have no clue about investing, just like don't pay attention to really anything in the financial markets, and they're like, dude, you got to jump on this. It's crazy. That's what we saw, right? The virtual real estate thing I always thought was stupid. The NFTs in general, I thought were stupid, right? Like, why am I going to spend $100,000 on like a digital, like a graphic design photo? Like, why? You know, that was, I think, greed and hype, right? That's all it was.
But you had a lot of people that made a lot of money off of selling it.
I know, but I hate that. I'm not even gonna lie.
100.
I hate that. I hate the idea of getting into something because you're riding the energy knowing it's trash and you're just trying to sell it before the bottom falls out. I just don't like that. And look, that's beyond NFTs. Like you can make the argument that people are doing that constantly in the market, right? Just don't like it. We actually, I hate it every time I say this, but we were doing a capital raise during the NFT craze. The NFT Bitcoin freaking bump of what, 21?
I remember this?
And so we're raising money, we're talking to investors, and it's interesting because when you talk to investors, most of them don't consider risk at all. They're only looking at return.
Look at upside.
Right. So they'll look at like, oh yeah, you're talking about doubling your money in 5. This place is going to double my money in 24 hours. I'm doing this one. Like it's a no-brainer, right? So we had a lot of people pass in 21. And I remember it got to a point where Michael and I looked at each other and went, when do you think we're going to start getting calls? And it's going to be panic style. Like we blew it. And I swear it was 6 months after. And we had friends calling us saying, I put everything on the line. I've lost it all. I had one friend in particular, he didn't know how to tell his wife because like he had lost everything. Right? You can't get caught up in that stuff. So this is like, if you want just like a very holistic macro viewpoint, this is what I would say. If you're watching everyone around you hype something up, don't go there. Don't go anywhere near there. Go in the opposite direction. Go where they think it's crazy, right? Go invest in California.
I mean, you knew something was wrong, right? When you're talking to people that are intelligent people, right? And they're telling you, hey, look, I'm taking a second mortgage on my house to lever up my investment in this blockchain and digital currency and crypto. And it's like, well, okay, I get it. If you think it's a good investment, that's fine. But you're going to lever up. Well, yeah, if I can borrow at 3 and I can earn, 1,000, I'll arbitrage 997%. Why not? I'll do that. And that was the moment where I was like, there is going to be a massive reaction to this, and not in a good way. And when we got the phone call from this one guy, like our hearts broke for him because it was like he was like, dude, my marriage is over. My marriage is absolutely over. And that was rough.
I don't know how you, I don't even know how you recover. I mean, I guess you just have to start all over, but I don't know how you recover from that. Like that's, that's tough.
Now, hang on, take a step back. I actually do think long-term NFTs are going to be huge. Not the ones we're talking about, not the photos, right?
Okay. Explain, please.
Okay, there is an element of NFTs like the contractual side that I think are going to be used in our industry. Like I think title will end up going into NFT.
100%.
I think like sub-agreements, all the documents that we have to create for investors, I think we will get to a point where it's all done blockchain. That is the only part of this that I think has the opportunity to be something good. As far as like the pictures, no, nowhere near it.
We're going to sell a monkey for $100,000. It's like, it's just not.
I'm kind of wiping out, like for most people, like 21 and 22. Let's just call that like a hiccup.
I call it the lottery years. Well, actually, no, I take that back. It was the year after like the COVID kind of subsided a little bit when like all the money just flooded into the market, all the PPP money and all that, the EIDL money. Y'all remember that? Like when all that money flowed into the market?
A lot of money.
Holy cow.
Okay, so what are you seeing right now? We're, a week out from the election? A week out? Are you seeing anything change on your end? Are you seeing investor sentiment change? Any difference from the lenders? What are you seeing?
100% investor sentiment is up. Probably, I would say 1,000%. I feel like there were so many people just sitting on the sidelines waiting to find out what was going to happen with the election. After this, we're flying out to Scottsdale. We're going to meet with an investment bank after this. And, we feel like the dry powder that was sitting there waiting for this to be over with is now finally saying, okay, we need deals, we need opportunities because we've been waiting so long that we have all this capital that we haven't placed and we need to get investor returns for our funds, for our, institutional wise. And so I'm seeing a lot of excitement in the market. I'm seeing a lot of, I mean, you see the markets right now. I mean, it's through the roof. It's nuts.
Do you think the appetite is because of who won, or do you think the appetite is because the election has already passed us?
I think it's because it's past us and everybody can like kind of just relax for a minute. And I think even honestly, and I think if it went the other way, I think the market would have probably just came to grips with, okay, it's over. And, you know, it's like this, we all have this like fear-based mindset that the world is going to end after the election. You know what I mean? Like that everything's going to go to hell in a handbasket no matter who wins. And I feel like once it's over with, it's like, okay, everybody gets back to their regular lives. You know, like the ads are over with. The thought of that is not there anymore. And so it's like, okay, let's get back to investing. Let's get back to doing what we do every day. And I think before that, people were just so scared of like, were there going to be riots? Were there going to be this? Were there going to be that? You know, like, is the market going to just crash, you know, like it did in COVID? You know, I don't know if you remember those days, like back early in COVID when the market was crashing. I just bought a stock because I knew it was going to come back. And same thing now with you know, with where we're at now. Powell's probably going to, you know, do another bump, I would imagine, in December. So we have another little bump down on interest rates. And I think now Trump's in office. I think he's a real estate guy. So I think a lot of that bonus depreciation stuff they may try to roll that back.
Oh, bonus depreciation's coming
that would
back
be,
for sure.
yeah. I mean, that's I think it's going to get rolled back because you know it's going to benefit him too. You know, so that's going to come back. And so I think real estate is going to continue to do. I think we were in a little bit of a slump there. I think this past year, I think values definitely declined pretty good. But I think now, I think we got another 2 or 3 years while he's in office to ride the wave. And I think the last year, this is like my prediction, the last year he's in office, it's going to get rocky again because I think people are going to start thinking, oh no, this is going to be the train is over. You know, what's going to happen? You know, who's going to be next? You know, and like we're going to be back in that zone again. So I think. We got a good 2 or 3 years of like good times in the market. I would say, me personally, what I'm trying to do right now is I'm trying to leverage the fact that the money's pouring in. Let's try to see if I can get a higher multiple in my companies, and be able to take advantage of that. And
Yeah, I was talking to a friend of ours, a broker that's done a handful of deals for us. And he was underwriting apartments, brand new apartments in LA. And he was like, dude, I'm trying to underwrite these things at a 5.25 cap and it's not working.
Oh my goodness.
He's like, I think it's going to go as high as a 5.5 cap, which is like crazy correction in LA. Yeah. So we've seen the correction for sure. Look, our outlook actually was very opportunistic or bullish a year ago, right? It's like when you see a market correct the way we did, oh yeah, like I want to get in as close to at that discount as possible because 5 to 10 years from now you're playing a different game, right? So as long as you're not flipping, it's a different strategy.
Well, the interest rates too are also in your favor, right? So imagine if you were buying buy and hold deals at a 7, 8, 9% interest rate, which it was like this past year. 7, 8% is very normal. You're buying deals at that, and then all of a sudden, you know, we start getting these little ticks down on the prime rate. You know, boom, point, you know, a quarter of a point here, quarter of a point here, continues to drop down, and then all of a sudden, mortgage rates start coming down a little bit. Then values start rising back up again. So you're going to be able to take advantage of that and be able to refinance those out, get a lower, you know, a lower monthly payment. You know, your cash flow is going to go up. You're going to appreciate your asset. So, and you're buying, you know, at a 7, 8% interest rate, you're buying at a lower you're buying at a lower value, you know what I mean? So when interest rates go back down, your value is going to go up. I mean, it's just simple math, you know?
Yeah, Mikey, explain that for people that don't know. Like, talk about how it's really commercial is valued and how cap rates and interest rates move with one another and what we've seen in this last year because of that.
Yeah, so it's all, I mean, unlike residential real estate, right? It's all numbers based, right? It's purely economics. And so if you take your revenue less your operating expenses in the real estate world, you come up with your NOI, which is what it costs to actually operate the property itself. The one expense you have after that is your debt service, which is your loan. But when you come up with the valuation number, you don't take the debt into the equation. And so you take that NOI number and you offset it by like a cap rate that's trending in the market, depending on the location, obviously the geography, what class property it is, size of the property, et cetera, et cetera. And so the market cap has a direct correlation to interest rates, obviously, right? And so there's a market cap that's placed on the properties that gives you a valuation of X. So because the rate is a function of the equation, when the rates move, the valuation moves in contra, right? So if cap rates go up, valuation goes down. Yep. If rates come down, valuation goes up. So basically, to his point, as rates were going up, cap rates moved up, you're effectively buying an asset that was valued much higher a handful of years ago when rates were low at a lower price point. Well, eventually, as we all think, rates are going to come back down. And as those rates come down, the valuation on that property is going to go back up. The income could stay flat. It could not change, and you're going to have a pretty big swing in the valuation. And as you know, I mean, even the properties that we're doing, we stress test all of our deals. And one of the things we stress is a pretty big fluctuation in cap rates. And so like one of the projects that we have like an exit cap assumption of X, and then the stressor is 200 basis points or 2% above X. The valuation is a hit of almost $10 million on that 2% change because the NOI on this property is big. And so any shift in interest rates, regardless of where they move, can have a significant change in the valuation itself. But to your point, you're right. It's like buying in an environment where interest rates are high, if you can weather the storm of being able to pay for the debt service, is a great time to buy.
Yeah.
Because eventually when the rates come down, you're going to get equity pop for having done no value creation, no increase in revenue, no expense reduction. I mean, solely based on interest rates.
And cash flow pop.